know too much in depth about interest rates. I know kind of the basics, how you can trade them with the 2 year and things like that, but I want to dive deeper in and ask you more about it. So,
And this is all coming from is this coming from movement in in interest rate markets, or are you just like are you genuinely just getting kind of hooked on the concepts?
Yeah, on the concepts and just kind of I don't want to be not educated in that area. You know what I mean? So I want to be able to spot opportunity and understand things for myself. And then even just understanding interest rates and again, how you can play that off the 2 year, that really intrigued me. So I think that's what really got me into it, just the 2 year and things like that. But yeah, I just wanted to be more educated in this area. So ready to get into it.
And I'm glad that it is dovetailing with, I talked with experienced trader Peter Molmat, who's been doing this for decades. We talked yesterday, and me and him both agreed that like right now is probably the most interesting yields have been, interest rates have been, the whole asset class has been since the start of the pandemic. So it's dovetailing with a very opportunistic, interesting time here. But you're exactly right, which is, and I see this with so many people is like, they kind of know interest rates. They understand like, oh yeah, bonds, like it's different than stocks and it's over there. And I kind of know how it works. If I've got like student debt or mortgage or something like that, I get it. They're percentages and they move and whatever, but they don't like to get over the hump and really understand the different durations, how those move relative to each other, why they move, and then go on to trade it. Once you get over that hump, like Errol is literally right in front of us, there is a whole world of opportunity that's very unique from stocks and everything else, as we'll get into it here in a second. But I just love to see people like their interests get piqued in interest rates for whatever reason. And then once you actually dive deep into it, it's like, all right, I'm going to actually try to understand this and trade it. Oh man, it's I want to speak the language. Class.
Yeah.
Exactly right.
Yeah, I want to speak
the language. Well, let's get into it a little bit here, and let's start with where you started, and what I think is a great place to start, which is just understanding a yield, whether it's 2 years, 5 years, 10 years, 30 years. They're all based off of the Treasury yield, just different durations. So what the U.S. Treasury yield looks like for a 2 year duration, or the next 5 years, or the next 10 years and 30 years, all different characters in the same film. Let's just look at one and how it moves. And you can see this one is up huge. You bought this a little while ago, and then you tried to get cute and sell it and get on the other side of it. It's been a huge move. This is a market that is up. Just notionally, it's up, 300% here on the year, a huge rise. And this is just coming from 2-year rates, 2-year yields, Treasury yields in the short term being at zero, Errol. And that's because we had the pandemic was really cooking last year, and there were a lot of economic difficulties. And thus the Federal Reserve was like, let's loosen, let's put these rates back down to zero and kind of take a little bit off the back of these companies and make it easy to borrow in these different things. Now that we're coming out of that pandemic and stocks are at all-time highs, the expectation is that they're going to hike those rates again, and thus yields are moving higher. I mean, this makes sense, right?
Right.
And so you bought this with the idea of just like, I'm buying yields, I think they're going to go higher. And is it that simple, or what was going through your head?
Yeah, I mean, I didn't put any fundamental piece to it really, but technically speaking, I saw the yields were down on the day and I wanted to get long little yields and kind of just trade it that way. So it was more of technicals rather than I'm over here understanding something fundamentally why I wanted to get long or short the 2 year.
And this market represents great price action, which is what Errol, I think, is getting at. It's great diversified price action relative to stocks and crude oil and all these, and crypto, all these different markets. And so on face value, it's got that in spades. As you can see, this market, it went from $1 to $2 back to $1 and then up to $5. It's got a lot of price action, and also this product, for those of you who don't know, costs about $75 to trade. It's just a $500 futures product, really as small as it gets. So a great place just to check out that price action like Errol was getting at. But I also want to get now a little bit more understanding and hopefully you feel a little bit more comfortable with this idea of less technical, more fundamental. If I'm buying this 2 year yield, I'm expecting that short-term interest rates move higher, and the biggest influence on that is the Federal Reserve. Is that all making sense?
100%. So if they're going to raise interest rates, maybe I want to get a little long here or something like that.
And what's also something to note is that $5 in any of the small yield products, $5 is 0.5%, or you'll hear a lot of times in yield talk, basis points. And a basis point is just 0.01%. So 100 basis points is 1%.
Right.
50 basis points is 0.5%. And so here, exactly right. Or $5 in this product. And so what you see here is the market at about 50 basis point or 0.5%. And that is going to relate to the Federal Reserve, or projections for the Fed, being that they'll bring short-term rates from 0 up to 50 basis points or 0.5% or 0.5%. They usually hike in 0.25% increments. And so essentially, if you're buying fives here, Errol, you're thinking that they're going to hike more than 2 times in the next 2 years or so. If you're selling fives, you're thinking, maybe they'll only hike once, or you'd really make a lot of money if they don't hike at all, and these projections for where rates are going come slamming back down to 0. Does that make sense?
Makes sense. I'm following so far.
Very cool. Now let's add a few other characters to the story, because you also have 10 years and 30 years, and correction to the last slide, only some Treasury yields are up. The 10-year and the 30-year actually have moved well off of their highs, especially that red line there, which is the 30-year yield. Now, a couple things to note here. The more duration that you add, the more years you add, Errol, the more that product's going to swing. And that kind of makes sense. There's more unknowns.
Right. It's a longer time frame, I guess you could say it. Just longer out, some more volatility, I see.
Exactly right. The way I always talk about it is like your 2 years or your 5 years. We don't have a 5-year product because if you got 2s, you don't really need the 5s necessarily. They're very similar. But if you're trading 2 years, that's kind of like your Coca-Cola. Like it's or like Disney stock, although Disney can be volatile too. But like it's got movement to it. It's going to do what you, if you buy it and it should go up, it's going to go up. If you sell it and it should go down, it's going to go down, and everything else. But it's not going to be ripping, with the volatility of a 10-year or 30-year, which would be more like your Teslas and stocks that are, if the Fed comes out and says something, these things are moving around a lot. And so the more duration you add, the more volatility you add. But also, you do get these environments, Errol. These markets are based off of the same product, which is, like I say, Treasury notes and bonds and the yields that are associated with them. So they're the same product, just different durations. And so their correlation is almost always at +1. But you have here a really intriguing market where 2-year yields are moving higher and 10s and 30s are moving lower.
Right. What's going on there?
So this is what I would call, and this is where the rarity of this moment in yields comes in. This is what I would call kind of growing pains for the yield curve. And so by that, I mean, everyone is kind of expecting that the Fed is going to go from 0 to 25 basis points, 50. They're going to be hiking in the next couple of years. And when you go from 0 to hiking, or you go from 1, 2, 3% being high up there and contracting and cutting rates, whenever you see that shift occur, stuff kind of goes haywire. Whereas when we're in a 0 environment, or we're in like a 2 or 3% environment, when you're in those environments, stuff is pretty chill and it acts like you would expect. But when you're transitioning in or out, you get these growing pains. And right now, what you're seeing, Errol, is traders thinking that the long end of the curve, 10, 30 years out worth of yields, those aren't necessarily going to rise, but the Fed will rise these short-term rates. And what's interesting, the Fed doesn't control long-term rates. They only control short-term rates. And so while they can really directly influence that 2-year, what they do doesn't necessarily influence 10 years and 30 years out. So what you have in these moments, these growing pain moments, is markets moving in different directions. Is that kind of making sense?
Yeah. So now I'm kind of thinking, will eventually the 10-year and 30-year follow the 2-year eventually. Like it kind of acts as a laggard, kind of, since it's
here we go, baby. This is what I love to see. That's the trade. And you have, so what we've just illuminated essentially is you have a whole curve of yields, thus the yield curve, and they all tend to move pretty similarly, but they can move differently amid some of these weird environments like we're in the midst of right now. Like look at the orange and red line, 10-year and 30-year yields. They're almost right on top of each other. There's some different movement, but they're right on top. And most of the time, 2 years are right there too. And you can see that actually, in the early part of the year, all three of them are moving higher. And then all three of them do dip here in July and August. But since September, that's when you've got the 2 years really moving higher and these other ones kind of moving lower. And those three pieces make up what is your traditional yield curve. And so what we're seeing right now, Errol, is this 2-year yield. And now just bear with me here as I try to show you this. This 2-year yield is moving up. Okay. These yields back here, 10s and 30s, are moving down. This is called flattening. Okay. And does that make sense? Like what I just showed you, that curve is going from, having a pretty decent angle to it to being decently flat, right?
Right. And so what does that tell us?
Okay. So from an economic standpoint, this usually is synonymous with like fear in the market. Like a lot of people traditionally like to say, oh, when the yield curve is flattening like this, or when it goes inverted potentially, which happens very rarely. When that happens, it's usually kind of portending potentially some potential economic strife, let's say. I don't want to say straight up a stock market crash, but that's what people tend to use that from an economic standpoint. From a trader standpoint, we just like looking at flattening like that, this kind of rare occurrence, as an opportunity for a potential trade in the opposite direction. It's all the yield curve from a specific outright perspective, whether you're just trading 2 years or you're just trading 10 years or just trading 30 years, they have some mean reverting aspects to it. And we talked about this, where it's like, if rates in any individual duration are significantly low or lower than they've ever been, there's a good chance they're going to come back up at some point. If they're way higher than they've ever been, there's a good chance that they come back lower at some point. It's one of the true markets, similar to stock market volatility, that kind of has a mean, and they tend to come back in line. Now, I would say with even greater confidence, spreads, the differences between them have an even greater mean reverting characteristic to them. And this is what you were talking about, is like, should we expect them to come back in line here? Should we expect 30 years to follow the 2-year higher? And that's what looking at the spread would necessitate. Okay,
I see. And you have the tub or the tube. It's not the knob spread. We got the 30-year and the 2-year this time. This is my first time seeing this one though.
This is considered the biggest yield curve trade, which is really nice given these products. You can see on the y-axis from $16 to $22. That's only $600 worth of this whole year's range in this spread. So while it is the most duration, it's the biggest spread, it's relatively small. And to your point, Errol, buying this spread at this low would get paid from 30 years following those 2 years higher. But you forget about the potential for the other side of the market, which how else do you think that this could pay you?
From instead of the upside?
Yes.
Or repeat that, the downside?
Well, so this could also pay you from that 2-year, which is run up so much, just coming back in the 30 years not moving. If you're catching my drift here. Okay, no, I'm not following. Could we go back just a little bit for a quick second? Okay, cool. So when you go back here and you see that white line, the 2 ripping higher, and the 30-year literally moving in opposite directions, if you put on that tub spread and you buy what's cheap, the 30-year, and you sell what's expensive, which is the 2-year, obviously you make some money if 30 years just bounce back and they rip higher than 2 years. That's a good side of the spread. But the other reason why spreads are so intriguing in trading the yield the yield curve as opposed to just one yield and betting on higher or lower rates is intriguing is you could also get paid if yields all move lower, but that 2 year just really dumps.
So you're saying if the 30-year kind of recovers, but also the 2 year is coming down as well while the 30 years recovering. And am I following?
That would be essentially the best situation, which is like the 2 years are dumping and the 30 years are hitting highs. That would be really something great. But I'm more speaking to like if yields move lower, all three of them, but 2 years are just really getting smacked. That's also a way that you could get paid from this as well, because you are long that red line there, the 30-year, but you're also short that 2 year, that white line there. So if the 30-year just kind of sits around where it is, but the 2 year really comes back here, you could also get paid from that standpoint. You've got two different ways for that spread to work out in your favor. Now, is all this stuff starting to, it takes definitely a few times of looking at this stuff to understand fully how the yield curve operates and why you're getting this weirdness and where the opportunity lies. But is this starting to at least make a little bit more sense? Yes,
it's starting to click little by little. Real quick, what does the TUB spread stand for? I know we have notes over bonds, but what is this one right here?
This is just twos to bonds. And
twos to bonds, okay.
Yeah, these all just have, they're honestly shorthands that just come from like, how easy is this thing for me to say? Coming from like back in the pits when people would be trading, the knob spread and the TUB spread and the fight spread, which is 5 to 10s, and the tough spread, which is 2s to 5s. If I'm in the pit and you're standing, 20 feet away from me and it's loud, I just want to be able to be like, Errol, I'm selling toughs. And so it's real easy. And then that's just as opposed to be like, Errol, I'm selling 2 years, buying 5 years. Like that's
you said you're buying 30 years, selling 2 years. No, I hear you.
So yeah. So this essentially, if we would be looking at buying the TUB spread here, we would be looking at buying that 30-year and selling that 2 year yield against it, which would be getting on the other side of this line, looking for it to bounce back higher. And that is actually called a steepener, which gets back to our little curve here. Like I was saying, you've got this whoops, and that's why you don't do this live. You've got this curve where everything's flattening, right? These things are moving down. The 2 year here is moving higher. And thus, if you are getting on the other side of this movement and you're buying this spread that has now moved lower, you want the yield curve to not flatten. You want it to steepen. And so what we're banking on now is maybe the 2 year moves a little bit lower, but also we could look for these pieces to move a little bit higher. And thus the yield curve goes from being flat to being steep. Kind of making sense, right?
Yeah. Now I see what you're saying. Now that you're talking about the steepness of the yield curve itself.
Exactly right. And thus, that's why I love it that you started with like, oh, I'm bullish on this or I'm bearish on that. Steepener and flattener are kind of the ways to refer to this amid the yield curve. If you're buying yield curve spreads here, you're putting on steepeners. You're hoping for the curve to steepen. If you're selling these spreads, then you're looking for them to flatten. You're putting on flatteners, which would be, you could put that on. Essentially, if I was putting on a flattener here, I would be of the mind that like the yield curve might go inverted. It could get really kind of crazy wacky, but putting on the steepener is more of a mean reverting play, kind of like a more high probability play here in this environment.
Okay, I gotcha. Steepener and flattener. So I'm selling if I want to get flat. Flattener.
If you want to put on the flattener, you're selling the spread. Exactly right.
Okay.
Yes. It is confusing because to flatten up or flatten a position, is a different term.
This is like a whole new world. I mean, yield curves in itself. I mean, we're not using bullish and bearish. We're going steepener and flattener, but it makes perfect sense because we have the yield curve and we have different parts of the yield curve, short term, long term. This is awesome. This is making sense. So I'm with you.
Awesome, man. I'm glad to hear it because this is, like I say, it's a very unique opportunity.
Yeah,
you can't get this stuff almost anywhere else. Aside from if you look into calendar spreads, which is a whole different thing for us. But where you have the same market, but you just have different durations. You have this curve of different prices in this same market. And it's like, ooh, I can take a position in one and an offsetting position in another and play a relationship of these things flattening and steepening against each other and not necessarily care where the market as a whole is going up or down. It's almost like I've surpassed the trivial bullishness and bearishness. I'm looking for steepening and flattening. It's your next level.
I hear you. I feel good. Welcome to the club.
Exactly. And thankfully, this is, a club that used to be just exclusive to like hedge fund traders and big bank traders and Frank at a prop shop in the Board of Trade, because the products were big and the products were complex. But now with the S10Y and the S30Y and the S2Y, they're smaller. They're easier to understand. They're just one-to-one. If I want to put this on, I'm literally just buying the 30-year and I'm selling the 2-year one-to-one. And that's a trade that only is going to cost me about $400. And so we've made huge strides to make this more accessible to you and me who just have a trading account at Tastyworks or wherever.
Yeah. And before Tastyworks, how was it putting on this type of trade? I know with Tastyworks, we can easily, pull up the pairs trader tab and, put these trades on. How was it before that?
Oh man, I first of all had to pay for a very, just like advanced technology, just because it didn't exist for retail everyday people. And so I had to pay for auto spreaders, these things that you'd enter in a price and it would trade both the markets at once. It would leg both of those markets for you so you don't miss one or the other. Tastyworks has that technology. A lot of other places now do as well. But what's really underrated, Errol, is when you trade this in traditional treasury products, which are like ZN and ZB and some of those, I don't know if you've ever seen those symbols, those products are big and they're expensive. And also they aren't one-to-one. You have to trade those like 3 of these to 1 of these. Oh, wow. And you end up in a pairs trade, Errol, that's costing you like 7,000, 8,000 in buying power.
Sheesh.
And so, yeah, it's way easier to get this stuff done. No crazy ratios. The pairs trader works really well. And it's smaller. It costs you $400, $500 to get one of these spreads done.
Yeah, that's solid. And then we got, some of the information that you're putting out. I mean, just these little graphs help the understanding of newer people into this kind of world so much with those simple graphs showing the yield curve. And I mean, that was pretty neat how you were pulling up and down the 2-year on the slides and showing that relationship. But even just that little bit of entry knowledge will help go a long way just to how to place a trade, just so you kind of know what you're doing. So it's pretty neat, honestly.
Absolutely. Yeah. The cost and technology is one thing, but education and understanding is another thing. And the last thing we want is people to be getting into trades that they don't fully understand. Thankfully, stuff is small and we're giving education for everyone out there. And I guess I might as well here plug the community that we are spurring here. We're giving people numbers and trade ratios and helping with the education every single week here for our community of traders. Join the Trader Revolution here today, community.thesmallexchange.com. 50% off exchange fees for life on all of our interest rate products and everything else. And we are constantly doing, live streams and different stuff, giving away t-shirts and everything else for our community members. And so I'm glad that you bring up, this is something new, man. No other futures exchange or stock exchange or any kind of exchange is on the ground working with people to understand the products and get everyday people so that they can understand them and trade a $2,000 account or a $5,000 account. This is truly a new thing. So join us here today, community.thesmallexchange.com. We'll be around for a while. You'll get your reduced fees and your education and grow with us here at the Small Exchange. Nice little plug there.
Yeah, I like it. So we just got to make interest rates cool.
Honestly, dude, I've been trying to do it for 5 or 6 years now, and maybe this is our moment. This is the time where interest rates are fine. Bonds used to be cooler than stocks. I don't know if you know this.
I didn't know that.
It used to be cooler to be a bond trader than a stock trader back in like the 80s. Yeah.
Oh, wow. Wow.
Yep. So we'll see. Maybe the tides, you know how trends go. Sometimes this is interesting. That's interesting. J. Cole, Grateful Dead. I don't know. We'll see what happens here. Thanks so much, Errol, for joining me here on Small Stakes. Always a pleasure to have you on. Go Bulls. You'll be watching for me tonight on the Bulls.
Yeah, I'll definitely be watching for you tonight to see if you're going to be a happy or sad man later tonight. Maybe I'll see some tweets. I don't know, but I'll be looking out.
Thanks. I appreciate it so much, man. We appreciate you being on the show. And I appreciate everybody at home for watching Small Stakes here. We'll be back tomorrow with Mikey G. But stay tuned. Splash into Futures is coming up next. A lot of markets on the move. We're going to get some trading going in the Tastyworks platform. Thanks for watching, everybody.